By the end of 2007, nearly 10 million American families would lose their homes. Trillion-dollar financial institutions would collapse in a matter of days. The global financial system came within hours of total failure, and almost nobody saw it coming. Almost nobody. Out of the massive global financial matrix, one unlikely person spotted the flaw, simply because he was willing to read the data everyone else chose to ignore. His name is Michael Burry. He operated out of a small, dim office in San Jose, California, far away from the traditional Wall Street hub. He also lacked the typical finance resume. Burry trained as a medical physician at Vanderbilt, eventually leaving his hospital residency to trade stocks full-time. In 2000, he launched his own hedge fund, Scion Capital, using a small inheritance and family loans. He had no Wall Street connections and no elite banking pedigree, but his medical training gave him a clinical, diagnostic approach to markets. He developed an obsessive habit of reading the dense, hundreds of pages long prospectuses that other traders skipped. By 2003, the American housing market was booming. Construction was everywhere, creating an atmosphere of permanent economic prosperity. Major institutional lenders drove this rapid expansion. They presented these household mortgages to the public and to investors as perfectly safe, reliable investments. To keep the money flowing, Wall Street utilized mortgage-backed securities. Instead of holding on to a single home loan, banks bundled thousands of individual mortgages together into a single large bond, selling them off to investors worldwide. The rest of the financial sector looked at the top-tier AAA ratings on these bundles and trusted them blindly. Burry decided to pull the raw prospectuses and read through the actual mortgages, loan by loan. The entire global economy rested on the assumption that these bundles were stable. Burry was the only person checking the structural foundation. Digging deep into the actual paperwork of these bundled loans, the terms Burry found were unsettling. He saw lenders approving mortgages for people with zero income verification. Buyers didn't have to show documentation or even prove an ability to repay. Absolute garbage loans were being packaged together, stamped with a pristine credit rating, and sold globally as premium debt. These toxic loans were secretly filling up the financial system by the millions, creating an incredibly unstable structure. Burry realized the American housing market was hollow. It was a fraudulent house of cards, disguised by the banks as a totally secure investment. Burry identified a mathematical mechanism that made a total collapse a certainty. This chart illustrates the trigger. These loans included what are known as teaser rates. Lenders offered artificially low initial interest rates for the first 2 years, designed to lure in buyers who couldn't otherwise afford the monthly payments. But then comes the reset. Once that 2-year introductory period ends, the interest rate violently spikes upward. The direct consequence was mathematically unavoidable. A massive wave of Americans would suddenly be unable to afford their spiked monthly payments, leading to mass defaults. Burry had pinpointed the exact trigger for the market's failure and the precise timeline for its detonation. While Burry stared at this terrifying reality, the rest of Wall Street continued to celebrate record profits, completely oblivious. But knowing a massive system is going to burn is entirely useless if you cannot find a way to place a bet against it. How does an outsider short the entire American housing market when the financial tools to do so don't even exist? Knowing a massive economic bubble is about to pop does you no good if you have no mechanical way to place a bet against it. In 2005, there was no simple way to short the housing market. You couldn't just sell subprime mortgage bonds short the way you would a normal corporate stock. The financial tools to do it simply did not exist. So Michael Burry decided to invent his own. He went directly to Wall Street's biggest banks and asked them to custom build a new instrument: credit default swaps on subprime mortgage bonds. These swaps functioned purely as an insurance contract. Burry would pay a regular premium, and in exchange, the banks agreed to pay him an enormous asymmetrical sum of money if those specific mortgage bonds defaulted. Because the banks believed a widespread housing crash was mathematically impossible, they were more than happy to take his premium payments. They willingly custom-built the exact weapon Burry needed to bet against them. But holding this insurance contract carried a massive counterparty risk. The payout would be completely worthless if the bank on the other side of the trade went bankrupt during the very crash Burry was predicting. He analyzed the balance sheets of the major players and deliberately cut out firms like Bear Stearns and Lehman Brothers. He judged them to be far too exposed to subprime debt to remain solvent when the loans went bad. Instead, he targeted a handful of firms he calculated could survive the fallout and actually pay out his returns. He focused his buys primarily through institutions like Goldman Sachs and Deutsche Bank. He started in May 2005 with $60 million in swaps against 6 highly specific, shaky bonds. By October, he had locked in over $1 billion in bets against the housing market. The trap was set, heavily armed with his client's capital. The only problem was that out in the real world, the American housing market was climbing higher every single month, showing zero signs of slowing down. Throughout 2005 and 2006, home prices defied Burry's thesis, continuing a steady climb to record national highs. Entire valleys were being carpeted with new developments. The physical supply of housing was expanding at a relentless pace to meet seemingly endless demand. Being early came with a steep mechanical cost. To keep his swap contracts active and avoid forfeiting his position, Burry had to bleed millions of dollars in monthly premium payments to the banks. This chart shows the direct financial toll of that bleed. While the National Housing Index continued its upward trajectory, the heavy cost of the premiums drove the Scion Value Fund's returns deep into negative territory, hitting minus 17.36% by the third quarter of 2006. Crossing that specific negative threshold broke the psychological resolve of his investor base. The steady erosion of their capital was too much to tolerate, while the rest of the market was highly profitable. Clients flooded Burry's office with questioning letters. The tone quickly shifted to aggressive demands for immediate capital withdrawals, and finally, outright threats of legal action against him. The very same people who had championed his judgment during the dot-com crash just a few years earlier were now completely convinced he had lost his mind. Burry found himself fighting a two-front war. His most immediate adversary was no longer the global financial system, but an angry mob of his own clients trying to forcibly dismantle the position from the inside. To protect the trade, Burry deployed a drastic countermeasure. He invoked a rare clause in his investor agreements to restrict all client withdrawals. It was an operational necessity. If he allowed the withdrawals, he would be forced to sell off the credit default swaps prematurely, taking a massive loss and effectively destroying his entire thesis. Locking up client money against their will is almost entirely unheard of. If his prediction about the housing market turned out to be wrong, this single maneuver would guarantee absolute career suicide. He had intentionally severed his last remaining ties to Wall Street consensus. Burry was entirely isolated, staking his fund and his professional future on a systemic collapse that absolutely nobody else believed was real. While his investors panicked, Burry retreated into silence. Working alone at night, he ignored the noise and focused entirely on tracking the raw numbers. He scrutinized individual mortgage servicing reports line by line, hunting for the very earliest borrower delinquency data available. In late 2006, the data finally cracked. Default rates on the most volatile subprime loans began a sharp, undeniable upward climb. Those rising numbers on Burry's spreadsheets translated to a sudden surge of physical foreclosures out in the neighborhoods. It created a bizarre dual reality. The foundational loan data proved the system was actively rotting from the inside out. Yet on the surface, the public illusion of a thriving housing market remained perfectly intact. Back in New York, the massive banks that sold Burry his swaps were quietly processing the exact same late 2006 default data. Realizing the danger, they initiated a self-preserving maneuver. They began secretly adjusting their internal valuations, bracing their own balance sheets for the incoming subprime collapse. Yet, even as they prepared for impact internally, these very same banks continued to aggressively package and sell the toxic mortgage bonds to the oblivious public as safe investments. Burry locked down his fund and survived his investors just long enough for the mathematical reality to finally catch up with Wall Street's delusion. His billion-dollar trap was secured, the mutiny was suppressed, and the fuse was lit. There was nothing left to do but wait for the inevitable detonation of the global economy. In the summer of 2007, the public facade of a permanently stable housing market finally began to crack. 2 hedge funds managed by the investment bank Bear Stearns collapsed essentially overnight. Those specific funds were overloaded with the exact subprime mortgage bonds that Michael Burry had bet against. For 2 years, Burry had faced constant investor hostility and widespread market denial for holding his short position. Now, reality was catching up to his spreadsheets. The initial mortgage defaults triggered a violent chain reaction. As individual homeowners stopped paying, the structure of subprime bonds started pulling itself down. Burry's data was no longer a theoretical projection. A real-world contagion was actively infecting the broader market. By 2008, the rot had spread far beyond the housing sector. The damage reached the highest levels of Wall Street, forcing Lehman Brothers to file for the largest bankruptcy in American history. Ironically, Lehman was one of the specific investment banks Burry had explicitly refused to trust with his credit default swaps, doubting their solvency early on. Institutions holding trillions of dollars in assets, banks that had spent years marketing these bonds as completely safe, were suddenly scrambling to survive the week. The global financial system tilted toward total collapse. Nobody alive had witnessed a liquidity crisis of this magnitude. For Wall Street, it was absolute destruction. For Michael Burry, the failure of these established institutions served as grim, very public vindication. The credit default swaps he had fought tooth and nail to hold onto exploded in value as the underlying mortgage bonds failed one after another. This graph tracks the performance of the general market over an 8-year period. If you invested in the S&P 500 in November 2000, by June 2008, your returns would have flatlined at roughly a 2% gain. Over that exact same time frame, Scion Capital generated net returns of nearly 490%. His edge never came from insider information or an elite Wall Street pedigree. It came entirely from the discipline to read the data that everyone else willfully ignored. The payout was massive, but the trade revealed a harsh reality. The true cost of being right early is enduring the crushing weight of the world's disbelief, until the math forces them to see it.